How's it going, everybody? We're going to do things a little bit different this week. Um, we're going to play off of last week's episode of watching for abnormal volume. So, abnormal volume, again, is above average volume. And what we're looking for is either looking for a breakout or a breakdown at these levels. And so what we're going to do is we're going to recap this week's runners. And we're going to go back and visit those, and we're going to look at their volume on their 5-minute and 1-minute charts, and we're going to compare that to what we know about abnormal volume. And this is how you can begin to practice your analysis of volume. You need to have hindsight in order to know what to do in the future. Of course, it's trading in hindsight. Yes, we know now what happened and that these are breakdowns and these are breakouts, but you have to analyze the volume that goes along with those. That way you know in your analysis that you have conviction that it's a real breakout or breakdown. So let's go back and visit this. Ignore TTOO. That's just a thing I had on my chart already. But first off, we're going to go through the most recent. No, we're going to save that for last. We're going to start back at the beginning of the week, and we're going to look at GBR. So GBR happened on September 16th. So let's look at September 16th on a 5-minute chart, okay? Straight out of the gate, let's switch to a 1-minute real fast just to kind of clean this up for ourselves. So, is that a 1-minute on the 16th? It is. All right, so now on this particular chart, we're looking for breakdowns or breakouts in key areas, and we're analyzing the volume in key situations. You can see that volume is very low for the stock. It was very low during pre-market anyway, but during this period of time at the open, one of the things that you'll notice here, this is what we refer to as a stuff candle, okay? If you've never seen that or do not know what it is, this is a stuff candle. A stuff candle is a candle that comes from below a level, tries to break a level, and then stuffs back under it. Think of it as like in basketball. A shooter will come from below, come up, try to shoot it, and get stuffed by the defender, right? They call it getting stuffed. So we are coming from below here at open, below VWAP. VWAP is a very important thing to many day traders, and so it becomes a self-fulfilling prophecy. So a lot of people will look at this and they will analyze that it has resistance here, but notice the volume, okay? This is what tells you what a stuff candle is. The volume tells you everything. What happens when that level gets rejected? It opens here, tries to immediately push, okay? The opening candle did 80,000 shares. That's not very much. So when it pushes here on literally double the amount of shares traded and creates a big wick like this, a lot of people got bagged in that. 90% of retail day traders, on average, are long traders. We have a lot of short bias traders, but 90% of retail that trades this stuff is long biased. 90% of the volume is long biased. Is probably a long trader. In most cases, that is the case. When there's a big short squeeze on a stock, you could argue that there's more shorts than there are longs. But in a situation like this, there are very much so more longs than shorts. And so knowing that 90% of retail go long, because that's what people are taught, they're taught that you buy low and sell high. That's just, I mean, I didn't even know what short selling was. I was literally a long trader, and I would buy it, and then it would die. And I was like, I swear to God, if there was a way that I could sell first and it drop and make money, I would be a profitable trader. And that's when I discovered short selling, and I was like, no way. There is no freaking way that I can sell something short, bet against the stock, and make money. There's no way. but it's true. And so I was attracted to the short side. But anyway, so when it rejects on volume, you know that based on, like Austin talked about in last week's webinar, or on this week's webinar, I'm sorry, on Thursday, that would have been Thursday, September 19th. He talked about behavioral finance. Trading small caps is very much behavioral finance. You're always thinking about where the day traders' minds are. Where are they underwater? Where are they taking profits? Where are they averaging up, averaging down, so on and so forth. You got to know who's in control, and it's all based on behavior and psychology. And volume is a very good indicator for emotions or behavior. Right here, this is a stuffed candle. This is a very great example of a stuffed candle. A push through a level that is trying to reclaim above pre-market resistance and consolidation, and VWAP right there, that little purplish line, pink, purple, I don't know what freaking color that is. It pushes through it and it rejects hard, okay? You're not doing anything in this candle. You're watching the candle. You're watching the candle. When you watch this candle and you see it open, start to push, and then as it pushes, it rejects hard. After it rejects hard, you wait for that candle close just to confirm. You start shorting pops. Now you have a set risk, okay? That's a little bit of hindsight trading there for you, but that is exactly why you wait for the volume to confirm. Wait for it to confirm. Next, let's jump on to YUMA, Y-U-M-A, on the exact same day, okay? YUMA was a big gapper on this particular day, and if you remember, YUMA has gapped several times. This is going to be the day in question right here, this red candle, okay? So if you remember, YUMA was a big gapper here and it sold off heavy. YUMA was a gapper here and it had a big wick and sold way down. It never actually opened at 232, okay? Just to be very clear there, that was a late print that happened. I don't know if any of you saw it. It was the weirdest thing I think I've ever seen in my entire life, but it happened. Anyway, so it gaps up big right here. Big gap up, okay? So you've got resistance here, you've got resistance here, here, and here, right? Now, let's go back to the chart, and let's jump back in the beginning of the week here. So, here at this point, after pre-market, what do we have? We're looking at market open. Now, you've got a big sell-off here on this candle. Big volume sell-off, the biggest volume. I mean, look at it compared to everything else. That's a huge volume candle. Huge volume candle at the open. It's falling down to VWAP. They're trying to support it. You've got a big wick here. You've got a big wick here. What happens? You get a big green bar. The green candle cannot overwhelm the red candle on the volume chart, right? So that means that there is more supply than there is demand. There's more sellers than there are buyers. So whenever this candle comes, and it literally just crashes on another 400-something thousand shares. So now you've got 500-something thousand shares, 400-something thousand shares, and every time that 400,000 or 500,000 shares comes through, it sells down hard. So that tells you again, sellers are in control. But you're waiting for the bar to close. You're not being emotional in this candle and it's selling down and you're like, oh my God, oh my God, oh my God, oh my God, oh my God. So it pushes hard, tries to pushes on 300,000 shares. 300,000 shares can't break a 500,000 share candle and then turns around and 400,000 shares sells it down really hard. It's very clear who's in control and why you should not be long this particular stock. Now, after that happens, you have the ability to now notice that the volume starts to wind down. The volume winds down, right? And your average begins to base right around this level. It still won't let me put a line there. Gosh. Anyway, so look at the first level right here. So that becomes really your average. Anything above this 140,000 in any single 1 minute bar is going to be above average volume or abnormal volume. So when you fast forward here, and we're looking at 115, we notice that we have a bit of an abnormal volume spike here, right? We have a bit of an abnormal volume spike. We go here and we reclaim over VWAP, and then we reclaim this high right here, probably caught some stop losses. Reclaim this high, okay? This is what you're doing real time, okay? You need to, a lot of people, they focus on the chart, and they think that the chart only has to do with the, like, resistance levels and the support levels. No, volume is a very big indicator. We all have it on our chart, but probably I would argue that greater than 50% of traders that only focus on the chart never look at the volume. They look more at the tape and try to find something, when in reality the tape makes the volume bar, right? So all you have to do is read the volume bars, and you're reading the tape. Who is in control in this period of time? It's not about what the tape says. It's what the chart says. And the chart includes a volume analysis right there. And your subjection and ability to analyze that is going to help you. So you analyze this volume and you look for the abnormal areas. This is an abnormal volume area right here, reclaiming an area, reclaiming a price level. Okay, once it reclaims this, what does it have? It has more resistance to run into. So this means don't go long. It's not a key breakout. It's not a key break to the upside of a significant price level. The only significant price level would be high a day and pre-market highs. That's the only significant price level in this particular scenario for a high of day break. So now let's go on to ACRS. ACRS we're going to look at on the 17th of September. So ACRS, this is pre-market action. We're looking at the open, okay? The open happens, and we have another big volume bar right here, right? Another big volume bar. Now look what happens. You have another big volume candle here that makes a wick, tries to push through it on the exact same volume, okay? With 100,000 shares less. Tries to push through it, can't break it. And then boom, what do you think comes next? Big rejection candle. This is a form of a stuff move. It's a very tiny range. It is a very, very small range. It is not a very extended stuff move, but it is a stuff nonetheless. And it is an open candle followed by a second bar that tries to reclaim VWAP and high of day, fails to do it, and is followed by this candle here. These two candles here, I would argue that if you combined them, it looks to me like this candle just kind of ran out of time, and this candle was coming right behind it. Like there was no, it was going to happen. So if you switch your time frames around, that you're now looking at this and say like a 3-minute chart, because you would encompass both of those. What is that? Boom, big rejection candle, right? So you're basically encompassing the first 3-minute bars. That's why a lot of people like 3-minute charts. 3 minutes is also a multiple of 15 divided by 5, or 5-minute candles divided by 15 is 3 is a multiple of 15, so on and so forth. So I don't know if I'm saying that right, but if you started with a 15-minute chart and then you divide it by 5, you're going to end up with 3-minute bars. That's the whole theory behind that. Is people are like, no, don't use anything less than a 3-minute, because that's an interval of 5 and 15, which is an interval of 30 and 60, and blah 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 blah. So they're trying to say that 1-minute charts shouldn't be used, and that's fine. I mean, to each his own. 1 is an interval of everything, so besides 0. But now on our ACRS, let's jump back in here. Let's get to the 17th here. Now on the 17th, again, you have that big sell-off, but notice what starts to happen. Where is the most significant volume bar outside of all of this? Pretty much, where would you put your average if you had it past 1030, right? Your average is probably going to land somewhere around this 225 level. So if you just look right here, really probably right about 161,000. That's pretty much your average, and you're looking for abnormal volume after that. And you've got several pieces of it. You got abnormal volume right here, but it doesn't break a key level. Okay, it breaks VWAP, that's fine, but your key level after this point in the day is not VWAP, it's high of day. It needs to break high of day on volume to really be significant. Okay, same thing you get here. You get a pullback to VWAP, you get a retreat, you get a push, you get another push, and then again, there's your big volume right there. So you're looking at this bar right here, which gets to a high of 193, and that is not. It's basically a high. It's basically a double top right there at the high of the day, and then it slowly grinds through. It can't push on big volume and really trap people. It's just a grind. It's a grind, it's a grind, it's a grind. They make a new high, they make a new high. It's not really much of a high. Here's a real big, nice push right here, okay? That is a nice push on good volume, but what happens? It's too early in the day for a break to really have some conviction. A new high of the day break that happens within the last hour of the day has the most power. Okay, that's why they call it the power hour. When it has power into the last hour with volume, that's the one that's really strong. That's the long that you want to focus on. If it breaks a new high of the day in the last hour on big volume, it's probably going to squeeze into the close. Okay, but you just have to be careful trading late in the day. It's very risky, because a lot of day traders are looking to either close their positions and sell it down or continue a squeeze. We haven't really had much of a market that offers stocks that squeeze in the end of the day. So ACRS is pretty much a moot point, because anything above average was right here, and we had a lot of above average volume and not a lot of price movement. And the key thing with ACRS to notice is one big difference. This is what happens when you have really high above average volume and nothing occurs. The reason for that is based on excuse me, sorry, is based on the share structure. Okay, so the share structure of ACRS here, we're just going to use FinViz real fast. Share structure of ACRS is 87% institutionally owned on a 39 million float. It takes a crap load of volume to move this at all. That's why when you look at something and you go, okay, abnormal volume, you want abnormal volume on a small float. Okay, you don't want to look at abnormal volume on a big institutionally owned big float. It's not going to behave like a normal small cap. It just won't. This is why many day traders avoid high institutionally owned stocks with big floats. Bigger floats being over 10 million. I personally avoid those. Not my favorite stocks. I don't like them. Next is SPI. 918. Whoops. 18. Next, here we are. Same thing at the open. Big sell-off candle right there, right? So that makes it really hard, okay? Now look what happens. Another example of a stuff candle here, but on lower volume, okay? Big sell-off. What happens? It opens, tries to push through VWAP, can't reclaim it, sells down, and then here we are, back to the lows. Now, this is a volume trap that has average volume, okay? And this is the thing to notice here. And Austin talked about this. This was his long indicator. See this candle right here? Look at the big wick on this candle. It makes a new low of the day, fails to panic. What's the average volume at this point? The above average volume would be above 250. So when this candle did not exceed 250,000 after it closes, you don't short. You avoid that. That helps you prevent from being trapped. Let the bar close. Don't short in the middle of the candle when it's a key breakdown. It's a breakdown that needs above average volume. So you need the bar to close to confirm. Once the bar has exceeded this and is broken, sure, short in the middle of it. Sell in the middle of the candle. But until then, don't. Just sit and wait. Sit and wait. Okay? Now your above average volume becomes this level here. Throughout the rest of the day, you have some above average volume areas that look abnormal. But again, what is happening here? There's no key breaks of price. Key break of price being high of day. You can't really squeeze. No ability to squeeze. No ability to squeeze. This right here is probably short covers. Right into that. This is what I'm talking about. Notice the last 30 minutes of the day, like I talk about all the time. What happens in the last 30 minutes of the day? Many day traders decide to either cut their positions and cover up or sell it and it goes blah. So this is a lot of shorts covering their position right here. They're buying it up. Longs are buying it up. And that all creates this. Many people think it's going to gap overnight, but what do you have? You have a lot of volume that's trapped over here. Everybody's going to be selling it down and runs into that, okay? This is behavioral finance. This is how you think about volume, not price. This is not hindsight analysis that says that I would have done this or that. That's not what I'm talking about here. This is the practice you need to continue to have every day, okay? Next, on AIM, notice here, pre-market highs are going to be here at 387, okay? Notice what happens. We sell off at the open. Not that much. It's a lot of volume, but not really an overwhelming amount. So it sells off at the open. Runs into this $3 level right here, which is pre-market support, right? Runs into that level on 400,000 shares. And then what does it do? It starts to reclaim, and we have a green close on this 1 minute candle. And then we have this push right here, which breaks above that high and that high, and it does it on 500,000 shares. So 500,000 shares breaks high a day, okay? But it can't break pre-market highs. Why can it not break pre-market highs? There's not enough shorts in this stock. So here's what happens, okay? What did a long do? This is exactly what Austin was talking about. This is volume analysis. This is all it is. What does a long do? A long is going to set a price target and sell it. So it becomes longs fighting each other. They think they're going to squeeze the stock, but they're not because there's not enough shares available to short, and shorts are not trapped because shorts create buying pressure, right? So when longs buy, they stop out shorts. And when shorts have to stop out, they have to buy. So longs push it up, shorts push it up, and that creates the squeeze. But when there's nobody short, the longs become sellers at higher price levels because they want to take profit, right? And then you, boom, you straight out get the rejection. And what happens here? Big candle on 500,000 shares. Now, what follows? A smaller candle on 500,000 shares, followed by another candle on 250. This is people taking profit right here. Guarantee it. Everybody taking profit that bought in this candle right here. Look, 500,000, 500,000. It's the same volume. It's the same volume. Volume analysis. Okay? This is what you're thinking in the middle of the trade. Okay? Now, later on in the day, you've got key price levels. This is pretty much going to be your abnormal zone. But now you can see how a death line works, okay? Look, this is going to look very unclear on this chart right here. But let's switch over to this. So, woo, that's a bright one. Hope you weren't watching this at night, because that'll blind you. So everybody thought the death line was 3. The death line is not 3, okay? Why is the death line not 3? The death line is 285, right? See that little dip right there? It looks like it's 3, but what happens if it breaks 3? It's going to run into 285, right? So it breaks 3. That's not a death line. It pops, because if you thought this was the death line here at 3, you got stopped out in that. But look at what the real death line is, and this is the proof. You see how the line chart has literally no little notches at all. No signs of support in this. It is just straight up and down. You hit here, pull back, this becomes your death line, okay? Any break below this, and it is just toast. And what happens? What happens? It breaks below that level. This is a bread and butter death line short. My gosh, I'm so upset I did not have shares. I wanted to short this so bad. 285 is the death line. You're putting all your orders around that 285 level, okay? I like to short a little bit above and a little bit below. I would have only gotten half size executed here, but man, goodness gracious. So that's volume analysis for the week, guys. We'll try to keep this going. If you guys like this stuff, let me know. If you don't, we'll jump on to other topics, okay? Have a good one. Sorry about that. I cut the video off because before I actually even went over the best abnormal volume example of the week that I said I was going to do, and I forgot. Sorry. So MDR. MDR was a recent just total mess. I don't even know what happened here, but on Friday, MDR was gapping up quite a bit, and so yeah, you can see here that it was just a train wreck. But what I want to show you on MDR is what it looks like when a highly institutionally owned stock, what it takes to really break it down, right? So at the open, on the 5-minute chart, you have a 7.2 million share traded candle with a range of about a whopping 30 cents. That is a crap load of volume and a tiny little range. So it can't break down, right? But later on throughout the day, we established pretty much an average right around that 4.3 million line, right? See that 4.3 million line right there? All the way across, you know, 4.3 over here. So right around 4.3 is your average volume. So you can see the candle that has an above average volume bar at a key breakdown point. The key breakdown point being right here at 250, okay? Key breakdown, 250. Whole $0.50, bar closes 242, gets as low as 228. Look at the amount of volume, 5.7. It exceeds your 4.3 million. It took an ass load of volume to break this down. Then you get the bounce, 3.3 million shares. Ain't going to do it, folks. It can't break 5.7 on 3.3 million. It just can't do it. You get the rejection, you get the further sell-off, the death line being here at 220, which is what Bao said in chat. When 220 broke, that was the end of it. 220 broke in this candle. Look at it. Where does it bounce right to? 220, and then you're back to lows right there. So this is the best example of abnormal volume. This is abnormal volume 2 right here, 6.3 million shares, because our abnormal volume earlier was 4.3, but it's not a breakdown. This is just that the stock is bouncing, okay? Got a lot of bounce to it, but it's not breaking above key levels, okay? So that's just something to keep on watch, to keep an eye up. So anyway, now we're going to call it done. So thanks, guys. Appreciate you. Thanks for watching.